Okay.
That's quite enough. Thanks, Avri.
Yeah, and then this stage is ends, and she will talk for about an hour, and then we will take questions for 20 minutes after that. Thank you.
Thank you. Thank you very much. And I hope I'll be less than an hour. Can I say what an honor it is to be part of your constellation, your company, and how wonderful it is to meet with Ering again after all these years. I think we last met in the 2000s, Ering. But anyway, it's also just wonderful to be reaching an audience in that part of the world, in your part of the world, in Turkey and around. And I know, of course, that's much wider than that, but even so, the connection with us and you is just very important, and I'm grateful for it. So I was going to talk about the fragility of the economic system. I am mainly a communicator about economics, and my mission is to make sense of economics for ordinary punters, for ordinary people. I'm not an academic, and I have no aspirations to academia. So let me see how I can move this along. How do I move my, yes. So I want to begin with this cartoon, which is widespread. Millions of people have seen it. Yes, the planet got destroyed, but for a beautiful moment, we created a lot of value for shareholders. And that's been transposed into this with a picture of Jerome Powell, the governor of the United States Federal Reserve. Sure, we destroyed the global economy, but for a beautiful moment, we tried to get inflation back to 2%. And I think those 2 points, those two issues are the major issues facing us today. So today's global economic order is designed, I would argue, to serve the interests of wealth, of those of the billionaire class, essentially. And that's what it's been designed to do, and that's what it's been extraordinarily successful in achieving. So I call it the billionaire economy. And one of the facts about the billionaire economy that I found astonishing was that in 2021, experts and brokers argued that in 2020, the year of the pandemic, when the global economy imploded, more yachts were sold, more super yachts were sold than ever before, with 2021 set to break sales records as well. So the globalized order, organized on terms of the 1%, is shaped by offshore capital markets and animated not by productive, sustainable investment, but by speculative rent seeking. This is what it's about. It's essentially a rentier economy, and it's been designed as such. And whereas in the past, good old-fashioned capitalists would invest in labor and in land to produce and manufacture goods and services, nowadays that's regarded as being rather foolish way to go. Much better to simply purchase assets and to collect rent from those assets passively without having to engage, if you like, in the broader sense of the word, with land or with labor. So you can avoid them both. So the globalized order is based on debt-fueled, export-led growth model, of which Germany and China are the models, i.e. all economies are oriented, if you like, to exports and to the expansion of exports. And Germany and China are the showcases for this system. Now, what's happened to my... So what the model does is to depress wages at home while boosting profits of exporters, or the 1%. And this has led to global imbalances, which in turn has led to trade wars and political tensions. So we have these very unbalanced economies, and Germany and China are the examples of it, but it's across the board, where the orientation towards exports means that investment goes into exports, but wages at home are kept repressed. That applies particularly in China, but also in Germany. So the next, oh, yes. The result is what the Federal Reserve shows us here in this chart, is the accumulation of assets by wealth per percentile group. And we see the top 1% have acquired massive amounts of wealth, whereas for the bottom 50%, their share of global wealth has scarcely shifted. And in the case of the United States, inflation-adjusted real wages are falling. They are below, they are in negative territory. People's wages are falling in real terms as they collect them now on a day-to-day basis. And they've been negative for a year and a half now in real terms, that is relative to inflation. So this is cutting wages by stealth, by inflation. At the same time, worldwide, labor's share of the global economy has fallen, both for so-called advanced economies, but also for low-income countries. This is a chart from the the Trade and Development Report of UNCTAD, which shows that labor's share of the economic cake, if you like, has fallen substantially over the years. So this is the world of the 1%. I like to show this image, which is from Instagram, of a celebrity. I can't say I know who she is, but she's there with her partner. They're both obviously musicians, famous for being famous. But the point about the image is that she posted it to show that they were arguing about whose jet to catch. This is her jet on the left, that's his on the right. They've each got their own jet in this little family, and they were arguing about who traveled on which jet. That's how reckless and how incredibly feckless our 1% have become with their wealth. And as we see in the United States, more and more private jets take to the skies in spaces. They also have a problem finding hangars in which to park their private jets. It's a big problem in the United States at the moment. There's so many of these. And why am I pointing this out? I'm pointing this out because the 1% is responsible for large proportion of cumulative greenhouse gas emissions. Now, the top 10%, and I have to say I include myself in that, about 640 million people, have accounted for about 52%, more than half of cumulative greenhouse gas emissions. The richest 1%, which is only 63 million people, accounted for over 15% of cumulative emissions. And that's more than double the emissions of the poorest 50%, the 3.1 billion people that make up 50% of the world's population. So what we see here is that the wealth not only are extravagant with their wealth, not only do they have extraordinary wealth, but they use that wealth to emit greenhouse gases, which are at the same time damaging to the ecosystem. So how do I move on from here? And here, this is simply from the Oxfam chart, which shows you the share of cumulative emissions from 1990 to 2015. And it shows you that the 7%, the poorest 50%, are responsible for only about 7% of emissions. So this is the tragedy of the structure of our current economy. And as a result of this extravagance on the part of the 1% and the top 10%, atmospheric CO2 concentration has dramatically increased. And this is an issue, of course, this week as we prepare for the new COP27. But the key thing I want to talk about is global net anthropogenic emissions. And the reason for it is this. The way in which the world talks about at COP26, at COP27, at all the COPs since 1990, when this chart begins, is in terms of what countries and regions can do to lower emissions. And the problem with that approach is that it enables, for example, Britain to say, we have cut emissions. We've been very good. We've closed down our coal mines. And we and we are virtuous. Unfortunately, China is still mining coal and is still producing manufacturing goods with coal. And therefore, China is the problem. Well, the fact of the matter is that Britain and Europe and the United States have outsourced our emissions to China. We no longer, we're an economy of coffee bars and banking. We don't manufacture or make or build things anymore. We've outsourced it. We've exported our emissions to China. And now we blame China for not cutting emissions. But it's worse than that, because we also indulge in fraudulent accounting. We don't include shipping and airline emissions when we count our emissions, because we say that's very difficult. The Brits can't account for emissions that cross continents and so on. It's a great let out, but it's also an accounting fraud. And so what's happened since 1990, when the first IPCC report was produced, is that total emissions and the climate and the atmosphere and the planet thinks only about total emissions. Total emissions have risen unrelentingly without any interruption, as if we had done nothing to cut emissions at all. So 2021, according to Professor Kevin Anderson from the Tyndall Centre in Manchester, saw the biggest rise in emissions in a very long time. So over the last 2 years, we know that something like 100 billion tons of carbon have been dumped into the atmosphere. There's absolutely no indication whatsoever that we as societies across the world are doing anything to lower emissions. Everything is about denial. Everything is about deferral. Everything is about delay. And again, this is a function, if you like, of the nature of our global economic system. But here's the thing. The question of inequality, the question of imbalances between the 1% and the 99%, these are not questions of morality. For me, this is a macroeconomic question, and it's a simple one. The wealthy spend only a small percentage of their income, not enough to keep economies churning, right? Lower income people, on the other hand, spend almost everything they have, and that is shrinking, right? What they earn is shrinking. And most workers aren't earning nearly enough to buy what the economy is capable of producing, which in turn leads to debt inflation, because rather than too much purchasing power chasing too few goods and services, we have the problem of too many goods and services chasing too little purchasing power. So consumers take on debt to try to keep up a basic standard of living, and firms are under pressure because sales fall short of targets. So this inequality and these imbalances have a massive macroeconomic impact. And that impact is overproduction on the one hand and underconsumption on the other. Now, this is a very different picture from that painted by many of Green's, which is that we're all consuming too much. We're actually producing too much. And because we've cut incomes across the board, that production is not being consumed. It's piling up in the form of gluts and surpluses all over the world. I see it every day when I go around Britain. Yesterday, I went to a garden centre to buy plants. The garden centre is turned into a general store. I've never in my life seen so many Christmas decorations on display as were on display at the end of October in a British department store. It's absolutely stuffed with gifts or with decorations which have come across in container ships from China in time for the Christmas market. Now, that's just one simple example, but it's actually reflecting a macroeconomic fact, which is that too little purchasing power is chasing too much production. And as I've said, what consumers and corporations are doing to deal with the gap between their incomes and their need to purchase goods and services, housing, and so forth, and energy, is to borrow money. And the IMF rightly has been worrying and ringing the alarm bells about global debt for a very long time. And the ratio of global debt to income is higher, and Steve Keen will probably talk about this more, is higher now than it was before the last financial crisis. So we know these imbalances are deeply embedded in the global economy and are a great risk to us. So China, for example, is in a country that saves more than it invests, and it runs trade surpluses to absorb its excess production. And Michael Pettis and Matthew Klein, in their book Trade Wars or Class Wars, make this case very eloquently. And this is a quote from an article by Michael, which appeared in the Financial Times. So what China is doing is suppressing wages and incomes at home. And now with the increased authoritarianism of the Communist Party in China, it will no longer be suppressing, but repressing wages and incomes. And China hasn't really moved sufficiently fast to develop, if you like, a welfare state, to develop a kind of welfare protection benefits for the population. So populations are really very insecure, naturally, because they don't have the kind of provision that guarantees them security in their old age or in ill health. And so they save rather than consuming. And China, instead of focusing on raising incomes and living standards in China, is instead focused on excess production abroad. And into this unbalanced and somewhat delicate situation in terms of the fragile global financial system, stumble the civil servants that are the governors of central banks across the world. And Bloomberg called them the elephants taking over the room. And they are elephants. They are behaving as elephants now, clambering over this fragile and unbalanced global economy, and threatening us all, I think, with depression and repression. There's something, and this week Martin Sandbu in the Financial Times had an article in which he asked, there is something seriously wrong with the prevailing ideas of monetary policy when central banks protect their credibility by driving economies into recession. A macroeconomic regime that cannot justify itself will be toppled, first intellectually, then politically. So we're seeing here in Britain, where our governor, the governor of the central bank, called on workers to not demand higher wages, not to demand that their wages should keep up with inflation. No, they were expected to take cuts in real wages. He actually advocated the year himself. So the point is, what we see happening is we see central banks intervening into this fragile and unbalanced global economy with high levels of debt and so on, in attempt to tackle what they call inflation. Now, I'm not sure that they are trying to tackle CPI, consumer price inflation, because there is no way that raising interest rates in the United States or in Britain or in Europe will do anything to lower globally determined commodity prices determined in global commodity markets based on the Chicago Mercantile Exchange. That there is no impact of higher interest rates on those decisions. Now, higher interest rates will, of course, lead to recession and the contraction of economic activity and falling incomes, naturally, as a result of their determination to impose recession on our countries. And that will no doubt lead to a collapse in the consumption of energy, of gas and oil, whose prices have been so abnormally high this summer, and food for that matter. But the direct intervention of central bankers is not for that. There may be some justification if central bankers are trying to slowly deflate asset prices. And it's been very striking that while central bankers are fixated on consumer prices. They have been utterly reckless in allowing asset prices to inflate massively over the last decade. Oh, by the way, I just wanted to share this quote from Isabel Schnabel, who's one of the more enlightened members of the European Central Bank. And she argued that current inflation is mostly driven by a strong increase in energy prices. Another factor is the pandemic supply disruption, of course. Our monetary policy, she said, has little impact on what is happening on global commodity markets. True. Nevertheless, a looming downturn would have a dampening effect on inflation. Of course, she said, we take this into account when calibrating our monetary policy. However, the starting point of interest rates is very low, so it is clear that we need to continue raising rates. So she is contradicting her argument in just 3 paragraphs. She's saying that they can't have an impact on inflation, but because real interest rates or policy rates are very low, it's clear that we need to continue to raise them. That is no rationale in my view. And she's right, of course, that real policy rates are still negative, are still extremely low. But, you know, even the tiniest movement in base rates, in policy rates, is enough to destabilize this very complicated, marvelous international financial system that is so fragile and unstable. It leads to the highest corporate bond yield since 2009. And this is going to be bankrupting corporations. Above all, it's going to be forcing corporations and individuals to begin to sell assets to deal with higher bond yields. And so what I'm wondering is whether, in fact, central banks are trying to deflate massively inflated asset prices. But the problem with deflating asset prices is that it has consequences. Now, first of all, the rise in rates that we've seen, that even though there rises in negative terms, policy rates, has led to this massive inflation of the dollar, of the price of the dollar over the last 6 months or so. And that, as you know, or you will know better than I do, has had a major destabilizing impact on currencies across the world, from Sri Lanka, but including Turkey, and indeed the United Kingdom, which is halfway along this chart. So, you know, what central bankers are doing now is indeed acting like elephants in this very precious environment that is our fragile financial system. And we see what's happening already in terms of China losing steam. Exports from China are beginning to collapse, and they account for 20% of China's GDP. That's an enormous threat to the Communist Party of China, and I think might go some way to explaining President Xi's authoritarian instincts, because it will lead to social unrest. And that slowdown in China is serious, as the IMF showed in their recent World Economic Outlook. The growth forecast is really quite dramatic, for dramatic falls in Now, why are central bankers focused on consumer price inflation? Why does this happen? And why are they not focused on asset price inflation when we've seen mortgage credit and real house prices averaged across 17 advanced economies since 1870 inflate in a way that we've never seen before? So why? So the answer is, first of all, CPI is easier to track. The price of gas, food, and mobile phones is easy to collect, right? Very few people will complain if the central bank takes action to bring down the price of consumer goods, and if they do that successfully. But bursting assets bubbles causes immediate pain, especially in the households of the very rich, right? And furthermore, and this is the point I want to end on fundamentally, asset price bubbles lead to global financial crises when they burst or when they're deflated. An asset price bubble was behind Japan's descent into deflation after the collapse of asset prices in 1989, the dot-com crash of 2000, the bursting of the US housing bubble, and the US credit bubble in 2006-07. And the unprecedented and often not spoken about market crash of March 2020, when the ECB and other central banks bailed out the Wall Street shadow banking sector, and which was precipitated by the coronavirus outbreak. That just gets covered over so easily and so is so little discussed, really. So what we see today, if we look around, we see bursting asset bubbles in tech, in retail, in crypto, of course, and in stocks and bonds. Pension funds, British pension funds were selling assets like crazy the other week in order to rush for cash. That has, I'm pleased to say, stabilized, and pension funds British pension funds find themselves in surplus after that little kerfuffle. Gilts continue to sell off on concerns about our government's fiscal plan, but stocks and bonds as a whole are having the worst first half returns in history. And investors are piling out of UK property funds after the bond market shock. Now, you know, we've been waiting for this to happen because prices in London have rocketed. They've become, you know, there's been a sort of process of ethnic cleansing in London. It's almost impossible for ordinary people to live in central London anymore. So people are commuting in from long distances to work here, but to afford to live here is now becoming a dream for millions of people. I'm very interested in this buy now, pay later bank, Klarna. I was at a conference of investors at the beginning of this year when I was told that Klarna and all these other small bank buy now, pay later banks were the future. This is the big story to come. And that valuation then was 46 billion and has fallen to 6.5 billion. So, you know, these little internet-powered news investments are imploding as we speak. Harvard is marking down its private assets, the valuation of its private assets. Losses at their 51 billion endowment fund could widen as private equity and venture capital funds cut the valuations. And I mean, we know that that's how the 2007-9 crisis began, when a private bank looked at its balance sheet, looked at the assets on its balance sheet, and decided the valuation of those assets could not be ascertained, could not be clarified. And it was that lack of confidence in the valuation of not only the assets on their balance sheet, but also on the balance sheets of other banks that caused interbank lending to freeze in August 2007 and precipitated the crisis. You know, I always wonder why that event gets so little attention, and Lehman's a year and a half later, a year and a bit later, gets far more attention. For me, this is one of the great, this is the asset that I watch as kind of a key indicator of what's happening in the global economy, because this is the asset that billionaires acquire in order to dash across borders and swap this for cash and avoid the customs and blah, blah, and regulators and so on. Well, the prices of Rolex watches are falling dramatically. So my cheerful conclusion is this: markets that have for the past century been described as the most liquid in the world are now subject to dramatic liquidity crises as buyers snap closed their purses and walk away from markets. I'll stop at that point, Sabri, and I hope I haven't used up an hour, and I hope it has made sense, and I'm very happy to take questions. Can you hear me? I can't hear you, Sabri. You've got to unmute.
Sorry about that. I just unmuted. Sure. I don't know if there are any questions from the YouTube side, but at least with the remaining participants here, we can start the questions. Anyone who wants to ask a question, please go ahead. You can raise your hand if you know how to do that here. Reactions.
Have I silenced everybody?
Or maybe well,
and let me start. Perhaps, what is your take on the new Green Deal episodes? How much of it should be put a trust, especially given its emphasis on the carbon trading system as almost the exclusive sole instrument?
Yeah.
And the net zero targets associated with that. Can you elaborate on us?
Yeah. So when we drafted
the
green, okay, yeah. So when we drafted the Green New Deal in 2007-8, we understood it very clearly as being about the links between the economic system and the ecosystem. The group that drafted the Green New Deal in 2007-8 was made up with environmentalists on the one hand and economists on the other, including monetary theorists on the other hand, and macroeconomists, right? And we had tremendous arguments because the environmentalists weren't interested in what we were talking about. We didn't understand enough of what the environmentalists were talking about. It was a big struggle. It took a year for us to produce this report. But what we came to agree was that you could not tackle the ecosystem unless you also tackle the economic system. And to put it crudely, you cannot tackle greenhouse gas emissions unless you tackle Wall Street. Now, the Green New Deal, so this is as we conceptualized it, and this is what is contained in my book, The Case for the Green New Deal, published in 2019. That case was picked up in a moderate way, in a minor way, by the UN and by other green organizations across Europe. But it didn't go very far until 2018, when we were approached by the Justice Democrats in the United States, who were putting up a candidate in a New York primary, challenging one of the Wall Street Democrats. And they wanted to help her build her policy offer. And she included in that the Green New Deal. And that catapulted the idea of a Green New Deal into the stratosphere. It became famous overnight. And of course, the Americans believe that they have, they have a special relationship to it because the New Deal was an American idea. But in reality, the thing that Roosevelt did in 1933 and the thing that we modeled in our report was he began by moving the government from Wall Street to Washington, to his offices in Washington, right? He said, we're the democratically elected government. We will decide on the major levers of the economy, the interest rate, the exchange rate, and the capital mobility and the level of public investment. We won't allow Wall Street to make those decisions. Now, I know this is a delicate point for you in Turkey, but the point was it was a democratization of economic decision making, and it subordinated Wall Street to the interests of society as a whole and of the ecosystem. And of course, Roosevelt wasn't only confronting unemployment and a massive financial crisis, the 1929 crash, he also was facing the Dust Bowl, the huge ecological crisis, where vast plains of the United States were eroded from over exploitation of the soil. So he tackled both unemployment and the ecological crisis because he managed to manage the financial system in the interest of American working people in a sense, and that was the model. So now, what happened when today's Americans picked up the Green New Deal? They focused entirely, as you say, on carbon pricing and on technology. They never touched Wall Street. They didn't go near Wall Street. And I can understand it's pretty dangerous messing with Wall Street. And Wall Street has more or less bought up the whole of the US Congress. So it's quite hard to take Wall Street as an American politician, I imagine. But that's distorted the way in which the Green New Deal is thought about now. So it becomes a technocratic effort, if you like, which doesn't really deal with the big issues of the economic system, which is responsible for these emissions. So, I've been talking about the way in which it's structured at the moment. The 1% Wall Street really isn't being interfered with at all. They can have as many private jets and as many fancy yachts as they fancy, right? There's no constraint on them accumulating large sums of money while wages in real terms are depressed. So that's what I think. And I think as a result, the Green New Deal has kind of been allowed to be marginalized. And the thing that disappoints me most is that it was the left that attacked the Green New Deal the most ferociously, really, because it didn't do everything, it didn't solve all the problems of the world. But anyway, so I'm afraid as a result, it's become less of an issue than it should be, in my view. I hope that answers your question, Eric.
Perfect. Thank you. Thanks much.
Right. Have we got...
Actually, we also have two other questions from Alev Yildirim. Unfortunately, she is not able to ask them in person because of her bad internet connection. So
yeah.
She wrote it. Let me read the questions she posed.
Yeah.
The first question, she said, many thanks for this great presentation. My question is about China.
Yeah.
Can we really call China a deregulated economy? That's the question.
I don't think, I don't think you can. I think there is heavy regulation, including capital controls, actually, which lots of people pretend doesn't happen in China. It is regulated. The economy is largely regulated, and the financial system is regulated. They try to manage the currency, for example. I noticed that lately that's been more difficult. And they try to manage the level of debt. So they do intervene and attempt to stabilize the economy. What they fail to do is to provide support to the population in terms of collective public services, basically. So people don't have, a guaranteed unemployment benefit or pensions or necessary care in later life. And it's that safety net which is missing, and that creates so much insecurity, I think, amongst Chinese savers. So I don't think it's a matter of it being deregulated. And I speak here as someone who's no expert on China. I'm generalizing here because mainly about the imbalances in China's relationships to the rest of the world in terms of exports and so
on. Okay, thank you. Let me ask her Alev's second question, written question. She talks about two countries, but evidently those two countries are Germany and China.
Yeah.
Let me read the question. My second question, if I may, is about economies mainly reliant on export-led growth, as you mentioned in your presentation.
Yeah.
Could you briefly elaborate on the possible impact of recession on the 1% and the rest in these two nations?
So, the impact of a recession will be marginal for the 1%. They won't feel much pain. They will make some losses. And we see, for example, Silicon Valley companies beginning to make losses. But I mean, given their massive capital gains they've made, this is not going to cause great pain. There'll be much more pain amongst the 99% in the event of a recession. So I think that's the situation, and what's happened every time we've had a crisis like this, and there's been the threat of recession, the central banks have come to the aid, if you like, of the 1%, because quantitative easing is liquidity that's aimed primarily at financial institutions with accounts with the central bank. And so so they've benefited from every crisis has consolidated the power of the 1%. I thought in 2007-8, as I watched the bankers, and the bankers were in a state of utter panic, they thought they were going to go to jail. And then they discovered that far from going to jail, they were going to be protected by the state, and their losses were going to be guaranteed. They were not going to be allowed to have losses. They were going to be too big to fail and too big to jail. And once they understood that, they couldn't believe their luck, and they went out and they've just got they've consolidated their financial power since then. So no, I can't see it. I can't see a recession having a great impact on it. The question is whether or not a recession will further destabilize the global economy. And I don't know that the recession as such will do that, but I think another shock could cause the system to topple. But it could take a climate shock. It could take the kind of shock that rocked the markets 3 weeks ago on the 23rd of September here in Britain. Who knows what it could be? You can't predict what the shock is going to be. It could be another pandemic. Who knows? But that is the thing that's more likely to affect the 1% and the system as a whole.
Actually, related with this, I have a question. We all observed what happened to the pension funds and the UK gilts and all that a few weeks ago in the UK.
Yeah.
There seems to be some problems, liquidity problems, also in the US Treasuries market. The financial plumbing, if you like, money plumbing.
Yeah.
And as you may remember, the US Treasury started talking about some sort of maturity transformation, that is buying back long-term debt, government debt, treasuries, and borrowing short-term to provide liquidity, especially to the repo market and all that. And do you expect some form of a financial shock that may come from there? Or do you expect that what the US Treasury is planning to do may alleviate the liquidity problems that we are already?
No, I mean, I think Sabri, the point is that just at the moment, as we begin to, part of the reason we have, a shortage of liquidity is because of quantitative tightening.
Correct.
Because the central banks are doing the opposite of easing. They're proposing. So we had that very starkly here in Britain. On the Thursday afternoon, the Bank of England promised to sell 80 billion pounds worth of gilts. Mm-hmm. And then on the Friday came the big shock, and they couldn't even think about selling, and they had to begin buying. Now, right now, the Federal Reserve is thinking of selling and is signaling that it will sell, and that it will engage in what is called quantitative tightening, i.e. not provide liquidity to the system. And that even that signal, before it actually happens, is causing panic amongst those who have leveraged borrowing against assets whose value is falling in real terms. You know, their valuations are falling. So they're beginning to see, I borrowed this crazy money against this asset. I discover the asset is not really worth as much as I thought it was. And now I owe all this money, and interest rates are rising, and the central bank is making it harder for me to access liquidity. That's what's causing the system to shake. Whether it freezes and whether it, you know, implodes is something that, well, I can't say for sure. But even these tiny moves with yields as negative as they are is enough to give quite a serious shock to the international financial system.
Correct. And there seems to be another cause for this lack of liquidity, not in the treasuries, but in the reserves in the US, and it's the so-called reverse repurchase agreements, deposits at the Fed. They are not going down. Well, they are not increasing as much as they used to be, but it's still a substantial, about 2 trillion or so, which reduces the number of size of available reserves for those trades. And one reason for this seems to be because of insufficient short-term U.S. Treasury debt, by the looks of it. This Operation Twist, if you like, may alleviate that problem and provide some liquidity, possibly, and together with this newly issued short-term U.S. government, that maybe they may find a way to avoid a potential crisis in the U.S. Money plumbing, but who knows? I mean,
who knows? I mean, we thought they could. We thought Alan Greenspan was a maestro back in 2007-9, and he could manage everything without anything going wrong. And it turned out he wasn't a maestro. So who knows? But the Fed is immensely powerful. The United States has got a huge and really quite booming economy at the moment, with full employment effectively, even though while wages are low. So, you know, the Fed has got immense capacity. The question is whether or not they really are, you know, alert to all of these threats. It seems to me that they're beginning to change their minds about further tightening, about further putting up of interest rates. They are beginning to get little indications that they might pivot, as the word is.
Correct. Like, for example, what happened in Canada today seems to be a sign for that, or as perceived by the market.
Yes, I missed that. So what happened? The Canadians?
If I'm not wrong, the expected interest rate policy rate hike was 75 basis points, and rather than 75, they did 50.
Right.
And the pivot is coming. Some people start to say.
It may not be enough, but I think, yes, they will. I've argued for a long time that they would pivot, and that
I agree with that. I mean, so one other thing that I have in mind is the following. What was the recent IMF report, the World Financial Stability or something like that, where they were talking about these open mutual funds? Open-ended mutual funds, which are essentially actually like shadow banks, if you like, right? Because if they're open-ended, then you can withdraw your money anytime you like. And with the asset prices going down, it is deflating, asset price deflation going on. That may lead to a bank run, they were saying in that report, and possibly that also creating some alarms in the U.S. government as well as the Fed, because it's huge. It's about $40 trillion worth. Shadow bank, group of shadow banks, if you like.
No, it's a market of about $52 trillion when I last looked, but it could be more than that. And I don't know who's counting, whether they're counting accurately. But it's a massive market and it's totally unregulated. And it's so irresponsible of central bankers to have allowed it to develop in this way. And I think, yes, it does pose a big threat to financial stability.
Yeah.
Right. So
any other questions?
Does everyone have English as a second language, Sabri, or
Other than Steve, of course, everyone here is like that.
Hey, I'm Australian.
Oh, well, yeah, well, we know about English is the third language in Australia.
Sabri, Alef has a third one in the chat box.
Yeah.
Alef put a third question in the chat box. If you.
Oh, I didn't see that.
In the chat. Right.
If you maybe you can read it yourself from there.
Okay, all right. Okay, that's Alev's third question. Thanks you so much, Alev, for your very interesting. Says, how long do you think Sunak will stay in his new role? And any comments about Braverman and UK's migration policy?
Oh dear, you're starting me on to something there. Now,
more lettuces, please.
At the most, he can only be here till, I think, January 25. So he's only got a year or so in which to kind of make amends for the disaster of the last 12 years. And we've had a pretty disastrous period in that time. I find Suella Braverman profoundly embarrassing. She's so damaging to Britain's reputation around the world. And so reckless, actually. She certainly isn't a professional politician. She behaves like, I don't know. I mean, it was her speeches last week were quite shocking. There's a big fuss being made here about the fact that he obviously did a deal with her because she's on the far right of the Tory party. He's on the centre right, if you like. But he needed the far right votes because there's 40 of them. Someone called them political hyenas on the backbenchers. And that wasn't me, that was Sir Christopher Chope, who's a Tory politician. He talked about these political hyenas on our backbenchers. And she's sort of the leader of the pack there. And I think his team must have said to her, if you vote for Sunak, you'll get your job back. And she was willing to give up her far right views to vote for him when she clearly didn't support him in previous elections in order to get the job. And she's got the job. But it's causing uproar here in Britain. It's been the headline news all day. How could he justify bringing her back after she claimed to have broken the ministerial code and so on? So, I mean, I don't know how long he'll stay. He's very young. He's only 42. His experience of British politics is limited. And he's about to embark on a period of austerity. And that is going to make people very, very angry because the sacrifices demanded of people whose wages are falling in real terms would be too much. And the other problem he has is our National Health Service, which, the nation is really devoted to the National Health Service. And the Tories have been privatizing it slowly. And it's becoming, and then, of course, and this answers your question, Alev, about migration. One of the reasons that Braverman fell out with Liz Truss was that Liz Truss was saying, we want to grow the economy, and we need more workers because we've got a labour shortage here. And we've got vacancies, I don't know how many, 25,000 vacancies in the NHS, massive vacancies in the restaurant sector. I heard a big businessman today complaining about the fact that he's had to increase wages by 22% in a year to keep his staff and to attract staff. So, big business is suffering here from a lack of labor, and she wants to curtail migration even further. And this is going to be a massive conflict between the business interests of the Tory party and the far-right extremism of what is effectively the Nigel Farage party. And she represents the latter. So, you know, it's going to be interesting. Nothing else.
Okay. There seems to be another question from Tansel.
Yeah, Tansel says, do you think that asset purchasing programs will be permanent or temporary? They will be an ordinary part of... So yes, I mean, I think quantitative easing was treated as if it were something kind of original and phenomenal that hadn't ever happened before. It was just a variation, in my view, on what central banks called open market operations. And it was the scale of those operations that had to respond to the financial crisis. And, you know, that is the way central banks manage interest rates, manage policy rates, at least, and so on. So it's going to continue as being one of the major tools a central bank has. Yeah. Tansel.
Yeah. I would like to ask a question about that part also. Continuing these large-scale asset purchase programs, one of the observations I made was that since not the ECB initially, but the Fed and the Bank of England, originally when they started these QEs or large-scale asset purchase programs, both the securities, bonds, not from the banks, but from non-bank financial institutions.
Yeah.
They did not only increase the reserves,
but
also the bank deposits and hence the broad money. Probably these large-scale asset purchases, when conducted that way, has another effect, which is to stop the contraction in the broad money. I mean, probably they use this as a tool to avoid debt deflation also, because the broad money was going down at the time. So in that sense, it's something a bit beyond the usual open market operations.
No, of course.
ECB is the long-term LTROs. What was it? The open expanded name, I don't remember, but
LTRO,
long-term refinancing operations or something like that, where they just gave reserves to the banks and it didn't help to expand the broad money, right?
And the thing is, I don't object to central banks bailing out the system at the moment of implosion, because if they hadn't, we would have all suffered. What I object to is that they did it unconditionally. You know, they assumed that this money, by if you like, providing liquidity to the financial system, that the financial system would then use that to invest in productive activity. But they didn't do that. They didn't lend the money on. They didn't use the money to, if you like, revive the economy. They used the money to speculate in the shadow banking sector. That's what, for me, is the objection. You know, I'm not objecting to bailing out the financial system, because the central banks, in a sense, were responsible for the structure of the system. And if it was so easily collapsed, then they had to take some responsibility for fixing it. But the point was, they did this unconditionally. You know, it should have been, you can have the money, but thou shalt do this. And if you don't, I'll take it back, right? But it was just sprayed around as to say, help yourself, you know, and that's why the finance sector that's why we have this problem of massive inequality, really.
Anyway,
there's one more question here from Sinan Haskan. How can green-focused growth become concrete in the long run with ambitious growth targets of advanced economies, since even under the pre-COVID conditions, fast growth, and this kind of is rising debate in spite of the pro-green economy discourses? That's a really big question, and I'm not sure if we have time to go there, Sabri. That's a big question. It's about growth in the economy, jobs, etc., etc. What do you think?
Your choice. We have been talking about 70 minutes or so.
Right.
And you must be tired by now. You have been speaking for quite some time.
Yeah.
Maybe we should end this webinar.
Yeah.
And I thank you very much for attending, and I thank Kadir University for taking my offer to start this webinar as part of their program at Kadir both to Erinç and also Özgür, who's the head of the economics department there. Thanks for everyone else, including Steve from afar, joining this webinar. Hopefully we will see you again in the next webinar coming Wednesday.
Thank you very much. And thank you to Erinç as well.
Thank you. That's great.
Real honor. Yeah. Goodbye. Cheers.